Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Trilogy Metals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our discussion. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For anyone looking at Trilogy Metals right now, the first thing you really need to understand is what the company actually is.
Right.
This is a pre-revenue exploration and development firm. You're just not going to find traditional mining revenue on the books.
And that fact alone would, scare off most value investors. When you look at the reports, you see a small net loss, maybe a penny or two a share. So if you're not investing in earnings, what are you investing in?
Exactly. The entire investment thesis here is driven by the quality of the assets and the success of the permitting process. We are assessing future value, not next quarter's results.
Okay, so let's unpack those assets then. We're talking about the Upper Kobuk mineral projects, the UKMP up in Alaska, a top-tier jurisdiction. But it's really a two-part story, isn't it?
It is, and this is a key differentiator. The flagship asset is the Arctic project. It's a highly valuable polymetallic deposit.
So lots of different metals.
Right. Copper, zinc, lead, silver, gold. But what's getting more and more important is the second project, Bornite. That one is heavy on copper and cobalt.
And having those in North America transforms this from just another mining bet into a strategic critical minerals play.
That's the key. And that polymetallic nature you mentioned, it provides economic robustness. If one metal price is down, the others can, pick up the slack.
Makes the whole operation more resilient. But the company is losing money now. What's the timeline for that massive inflection point analysts keep talking about?
Well, the market is pricing in a huge step change. But it all hangs on one thing: getting the permits for the Arctic mine. That key milestone is currently targeted for 2026.
Wait, 2026? In a place like Alaska with a pretty controversial infrastructure project needed to service it, that sounds, well, aggressive.
And that skepticism is fair. It's the primary risk, and we'll definitely get into that. But the reason the market gives them the benefit of the doubt, it really traces back to their fundamentals, specifically the balance sheet and their partnerships.
Which brings us to financial stability. Usually for a pre-revenue explorer, we're talking about a company drowning in debt, constantly diluting shareholders. But Trilogy is different.
They truly are. They have a strong equity base and virtually no debt. For a company like this, that's a huge advantage. It gives them a cash runway for years of work without, the pressure of a bad market forcing their hand. It's a crucial buffer against those very permitting delays you mentioned.
So that financial stability feeds right into their competitive advantages, their moats. What's the most powerful one?
It has to be the strategic partnership. The assets are operated through the Ambler Metals joint venture. It's a 50-50 partnership with South 32.
And South 32 isn't some small player. They're a major, diversified global miner.
Exactly. That partnership is an enormous stamp of credibility.
Oh, absolutely. It instantly solves, three major problems?
At least. First, you get deep technical expertise. Second, financial stability. They share the massive future construction costs. And third, and maybe most important, it signals confidence to regulators and other investors. It dramatically reduces the need to keep diluting shareholders.
Okay, so that's the partnership mode. Let's talk about the policy mode, because the government backing here feels unique.
It cannot be overstated. We're talking about formalized government backing. The JV just announced a US $35 million program and budget for 2026, all focused on getting ready for permitting.
But there's an even bigger signal coming directly from Washington, isn't there?
Yes, that JV spending is being complemented by a direct US $35.6 million US federal strategic investment in that very district. When the government puts that kind of money in, it's a signal. They see this as vital for domestic supply chains of copper and cobalt. It de-risks things significantly.
So we have the partner and the government. That's a huge barrier to entry. But what about the asset itself? Why is the Arctic deposit considered so good?
And that's the third mode, asset quality. It's what miners call a high-grade polymetallic VMS deposit.
Okay, jargon alert. Break that down for us.
Right. VMS just refers to how the deposit was formed. The important part for you, the investor, is high grade and polymetallic. High grade means they have to process less rock to get the same amount of metal. That drives down costs a lot.
So once it's built, it should be a very low-cost mine.
Exactly. It's projected to sit way down on the global cost curve. This means that even if copper prices fall, this mine would likely stay profitable while its competitors would be shutting down. It's an economic fortress.
So you combine all that, high-grade assets, a top jurisdiction, a major partner, and direct government support. You can see why this isn't just another speculative junior miner anymore.
Absolutely. The fundamentals are strong. So now let's look at how the market has reacted.
And the market has definitely noticed the price action has been, well, spectacular. This isn't just a small rally. We're talking gains of, what, 169.8% in 2024 and then over 300% in 2025. This is a powerful re-rating.
A re-rating is the perfect word. The market fundamentally changed how it values the business. It went from a speculative multiple to a strategic asset multiple. Investors now see this as a leveraged play on North American copper security.
So the stock's trading around the 480 to 492 range right now. After a move like that, the fear is always that it's overbought. What do the technicals say?
Well, the stock is still trading way above its long-term trend, the 200-day moving average, which is down around $2.49. So the trend is strong. But the crucial point is the short-term momentum indicator, the RSI.
And that's telling us what?
It's sitting right in the neutral zone, near 45 to 50. This tells traders the stock is just digesting those massive gains, not collapsing. It's a constructive reset within an uptrend. It gives the stock room to run on the next catalyst.
So if that trend continues, what kind of upside are analysts seeing? What are the price targets?
The average 12-month target is right around $7.75. The high-end targets go up to $10.
So from current levels, that's a potential upside of what, 30% to over 100%?
Correct. The market believes the full success of that 2026 permitting window still isn't priced in.
Oh, okay. That is certainly exciting, but we have to pivot. Let's play devil's advocate and be brutally realistic about the risks. The whole thesis hangs on regulation.
The primary risk, hands down, is permitting. It's not just the mine permit, it's inextricably linked to the contentious Ambler Access Corridor.
For listeners who don't know, what exactly is the Ambler Access Corridor and why is it so contentious?
It's the road, the proposed infrastructure needed to physically get to the remote mine site. Without that road, the mine isn't economic. And it's contentious because it crosses federal lands and has faced, legal challenges from environmental groups and some indigenous communities. Delays there are the biggest threat.
And then there's the financial risk. Negative cash flow now, billions in construction costs later. That raises the risk of future dilution or costly debt.
That's the classic bear case, yes. But this is exactly where those moats we talked about act as a powerful counterbalance. First, the partnership with South32 immediately cuts that massive capital burden in half.
So they only need to worry about raising half the money.
Exactly. And that's further buffered by the U.S. federal funding signals. This triple layer of defense, a good balance sheet, a major partner, and government backing. It's not your typical cash-strapped junior.
And you could argue that with the massive run-up in the stock, the market already recognizes this is speculative. The risk is baked in.
That's a great point. The fact that analysts still see 30% or more upside suggests that if that regulatory risk fades, if we get good news on the road, the stock has room for a very rapid jump, asymmetric upside.
So with that big permitting decision still a year or two away, what should investors be watching for over the next, say, 3 to 6 months?
Focus on execution. Look for confirmation that money from that U.S. $35 million program is being spent efficiently. Look for updates on technical studies, on drilling plans. Every update that de-risks the future mine plan is a small win.
And what about the broader macro picture? What could drive the stock outside of company-specific news?
There are significant tailwinds. We're seeing a rotation to hard assets, especially copper. Trilogy is a highly leveraged play on the energy transition. Any dollar weakness, any acceleration in decarbonization policy, that's an immediate lift for a stock like this.
And the M&A angle, the speculative element.
It's huge. This is a logical consolidation target for a major miner wanting North American exposure. If the road gets a green light, M&A talk could heat up fast. You could also see offtake deals with EV or battery makers who are desperate to lock in long-term copper and cobalt supply.
Okay, let's bring this to a close. Let's summarize the final thesis for the investor.
If we connect it all back, Trilogy Metals is a high-beta, district-scale play on U.S. critical copper and cobalt. It's uniquely backed by a world-class asset, a major partner in South32, and direct government funding. That's a competitive position very few juniors have.
That combination quality, partnership, and policy is the foundation. The real question for an investor is whether you believe the political will to secure these minerals can overcome the regulatory hurdles.
Our final thought for you is that this is best suited as a multi-year hold anchored on that 2026 permitting window. You have to see the current negative cash flow not as a loss, but as a front-loaded investment into strategic, long-life assets. If execution aligns with policy, the upside is substantial, but it requires patience.
Thank you for joining us for this analysis. If you enjoyed this in-depth look at Trilogy Metals, subscribe to Smart Wealth with Joshua for more daily stock analysis and catalyst talks. We'll see you next time.